Right now, a lot of people are letting their cash sit in a regular bank account without realizing how little that money is actually doing for them. You work for your money, you save it, you keep it in the bank because it feels safe. But then the bank pays you almost nothing for keeping it there. And the crazy part is, that same bank is not just letting your money sit. They are using deposits to make money in the background. They can lend money out. They can earn interest. They can use your cash inside their financial system. But you, the person who actually owns the money, may only get a tiny amount back. That is why I started looking for a better place to keep cash, not risky investing, not crypto, not stocks. Just a better place to keep everyday money and emergency savings. And one account that kept coming up was the Fidelity Cash Management account. Now this is where it gets interesting, because this account is not exactly a bank account. It is technically a brokerage account. But for everyday use, it can feel a lot like a checking account. You can get a debit card. You can set up direct deposit. You get a routing number and account number. You can use bill pay. You can write checks. You can deposit checks from your phone. You can move money online. And there are no monthly account fees or minimums to open. So from the outside, it looks like a normal spending account. But the way your cash is handled is different. At a normal big bank, your checking account usually earns almost nothing. Your savings account may also earn very little, especially if you were using one of the major banks. But with the Fidelity Cash Management account, your cash can be placed into a core position. One of the popular options is Fidelity's Government Money Market Fund, also known as SPACs. And instead of your cash just sitting there doing nothing, it can earn a much higher yield than what many big banks pay. Now, I am not going to give you a fixed number here because the rate changes. Before you record this video, check the current SPAC 7-day yield and say the exact number. But the important idea is simple. Your everyday cash may be able to earn real interest while still staying accessible. That is the part most people miss. They think they need one account for spending and a completely separate account for savings. But with this setup, your cash can still be available for normal use while earning in the background. Now let me break down how this actually works. When money lands in the account, Fidelity can place it into the core cash option you choose. If you choose the money market fund option, your cash goes into a fund that holds short-term government-related securities. This is not the same as buying individual stocks. It is not meant to move up and down like the stock market. It is designed to be a cash management option. But there is one important thing you need to understand. SPACs is not FDIC insured. That is where a lot of people get nervous, and honestly, that is a fair thing to ask about. Because most people hear not FDIC insured and immediately think it must be unsafe. But you need to understand what kind of account this is. Fidelity is not a bank. This is a brokerage account, so the protection works differently. Money market funds inside a brokerage account are generally covered by SIP protection if the brokerage firm fails and customer assets are missing. SIP-C is not the same as FDIC. FDIC protects bank deposits. SIP protects customers of brokerage firms if the firm fails and securities or cash are missing from the account. So you should not confuse the two. SPACs is not FDIC insurance. It is a money market fund inside a brokerage account. That means it has different rules, different protection, and different risks. Now, Fidelity also has another option for people who really want FIC insurance. It is called the FIC Insured Deposit Sweep Program. With that option, your cash is moved across partner banks so it can qualify for FIC coverage. The trade-off is usually the rate. The FDIC sweep option often pays less than the money market fund option, so the choice depends on what matters more to you. Do you want the higher yield from the money market option, or do you want the FDIC sweep option for extra bank-style insurance? Neither option is automatically right for everyone. It depends on your comfort level, your goals, and how you use your cash. Personally, the reason people like the SPAX option is because it can pay much more than many traditional bank accounts. But again, check the current yield before making a decision. Now let's talk about the features, because the yield is not the only reason people like this account. The first big feature is ATM fee reimbursement. With many banks, you have to find their specific ATM network. If you use the wrong ATM, you get charged. Sometimes the ATM owner charges you. Sometimes your bank charges you too. And if you are traveling, those fees can get annoying fast. With Fidelity's debit card, ATM fees can be reimbursed when you use eligible ATMs. That makes it very useful for people who travel or people who do not want to hunt for the right ATM every time they need cash. The second big feature is no foreign transaction fee from Fidelity on debit card purchases. This matters if you travel outside the country. A lot of debit cards charge an extra percentage when you use them internationally. That may not sound like much on one purchase, but if you were traveling for a week or two, it adds up. With Fidelity, that extra foreign transaction fee is not charged by Fidelity. So for international spending, this account can be much cleaner than many regular debit cards. The third feature is the fee structure. There are no monthly account fees, no minimum balance requirement to open, free check writing, free online bill pay, free mobile check deposit, free online transfers, and many of the normal money movement tools people expect from a checking account. That is why some people use this as the center of their cash system, not because it is flashy, but because it removes a lot of the small fees that traditional banks love to attach to basic services. The fourth feature is that your cash can keep earning automatically. This is where the account becomes interesting for emergency funds. Think about how most people store emergency savings. They might have $5,000 to $10,000 or $20,000 sitting in a basic savings account. That money is supposed to protect them. But while it waits, it may be earning almost nothing. And inflation slowly eats away at the value. With the Fidelity Cash Management account, the idea is that your emergency fund can stay accessible while also earning a stronger yield in the background. That is a much better setup than letting cash sit idle for years. The fifth feature is simplicity. A lot of people have money spread across too many places: checking account at one bank, savings account at another bank, brokerage account somewhere else, IRA somewhere else, emergency fund in another app. Then every month, they are moving money around manually. With Fidelity, if you already use Fidelity for investing, adding the cash management account can make your system cleaner. Your spending cash, savings cash, brokerage account, and retirement accounts can all be easier to view in one place. You can move money between Fidelity accounts more easily. You can set up recurring transfers. You can automate investing. You can make your cash management feel more organized. Now, does that mean everyone should close their bank account and move everything to Fidelity? No, that is where people need to be careful. This account is useful, but it is not perfect. There are some downsides you need to know before moving your money. The first downside is physical cash. If you regularly deposit paper cash, this account may not be enough by itself. You cannot walk into a Fidelity branch like a normal local bank and deposit cash the same way. So if you get paid in cash or use money orders often, you may still need a local bank or credit union. That is why I would not tell everyone to completely replace their bank. For some people, the best setup is to keep a simple no-fee local checking account for cash deposits and use Fidelity for savings, spending, and cash management. The second downside is Zelle. If Zelle is a big part of how you send and receive money, you need to check whether this account fits your routine. A lot of people use Zelle every week. They send money to family. They split rent. They pay friends. They receive payments. If your whole money system depends on Zelle, this could be a real inconvenience. You may still be able to use other payment apps, but Zelle support is something you need to verify before switching. The third downside is account linking. Some apps connect easily to big banks through instant login tools. With Fidelity, some connections may require manual routing and account number setup. That is not the end of the world. It usually only takes a few extra minutes. But it is not always as smooth as connecting Chase, Bank of America, or Wells Fargo. So, if you use budgeting apps, payroll apps, rent apps, or other services, test the connection before you move everything. The fourth downside is deposit holds. If you open a brand new account and move a large amount of money, some funds may be held for a few business days. This is common with new financial accounts, but you need to know this ahead of time. Do not move your entire emergency fund on Monday if you might need all of it on Tuesday. Start small. Test transfers. Make sure everything works, then move more money later if it fits your situation. The fifth downside is that this still requires you to understand what you are using. A bank account and a brokerage cash account are not the same thing. A money market fund and FDIC bank deposit are not the same thing. SIPC and FDIC are not the same thing. So if you are the type of person who wants the simplest possible setup with traditional bank insurance, the FDIC sweep option may feel better to you. But if your goal is to earn a stronger yield on idle cash and you understand the account structure, the money market option may be more attractive. Now let's compare this to a regular bank in plain English. With a big bank, you usually get convenience. You get branches. You get ATMs. You get Zelle. You get basic checking. You get FDIC insurance. But you may get very low interest. You may get monthly fees if you do not meet requirements. You may get ATM restrictions. You may get foreign transaction fees. And your savings may not be working very hard. With Fidelity Cash Management, you get a different trade-off. You get no account fees. You get competitive cash yield options. You get debit card access. You get bill pay. You get mobile check deposit. You get ATM fee reimbursements. You get the ability to connect spending, saving, and investing in one place. But you give up some traditional bank features like easy physical cash deposits and possibly Zelle convenience. So the real question is not, is Fidelity better than every bank? The real question is, what do you actually need your bank account to do? If you deposit cash every week, you may still need a local bank. If you use Zelle constantly, you may still need a regular bank. If you want in-person banking, you may still need a regular bank. But if most of your money is digital, your paycheck comes through direct deposit, you pay bills online, and you want your idle cash to earn more, this account starts to make a lot of sense. Now let's talk about emergency funds. This is probably one of the best use cases. An emergency fund should do three things. It should be accessible. It should be stable, and it should earn something while it waits. Most people only think about the first two. They want the money to be easy to access. They want the money to be safe. But they forget that the money could sit there for years. If your emergency fund is sitting in a basic savings account earning almost nothing, you may be losing buying power every year. That does not mean you should invest your emergency fund into risky assets. You should not put emergency cash into something that can drop heavily right when you need it. But a cash management account with a money market core option can be a middle ground for some people. You still keep liquidity, you still avoid stock market risk, and you give the cash a chance to earn a more competitive yield. Now here is an example. Let's say you have $20,000 set aside as emergency savings. At a normal big bank paying almost nothing, that may earn only a few dollars in a year. But at a much higher cash yield, that same money could earn hundreds of dollars over time. That is money you did not have to work extra hours for. That is money your cash earned just by being parked in a better place. Again, the exact number depends on the current rate. So do not use old rates blindly. Check the current yield before you make the claim in your video. Now here's another thing people miss. This account can also help with automation. If you want to invest a set amount every month, you can set up recurring transfers. If you want part of your paycheck to go towards savings, you can automate that. If you want your extra cash to be connected to your investment accounts, this can make the process smoother. So it is not just a place to store money. It can become the hub of your financial system. Your paycheck comes in. Your bills go out. Your emergency savings earns in the background. Your extra money can move toward investments, and everything becomes easier to track. That is the real power of the account. Not just the yield, not just the debit card, not just the ATM reimbursements. It is the combination of cash access, better yield potential, and simple money movement. Now, before anyone hears this and thinks they should move all of their money today, slow down. Do not make a financial decision just because an account sounds better. Look at how you actually use your money. Ask yourself a few questions. Do I deposit cash? Do I need Zelle? Do I use physical bank branches? Do I want FDIC insurance specifically? Do I understand money market funds? Do I already use Fidelity? Do I want my savings and investments in one place? Do I travel often? Do I pay ATM fees? Do I keep a lot of idle cash? The more of these questions you answer honestly, the easier the decision becomes. For some people, Fidelity CMA could replace most of what they use a checking and savings account for. For others, it may work better as a second account, and for some people, it may not be the right fit at all. Here is how I would think about it. Keep a basic local bank account if you need cash deposit, Zelle, or branch access. Then use Fidelity Cash Management for the money you want to keep liquid but still earning a better yield. That could be emergency savings. That could be short-term savings. That could be travel money. That could be extra cash waiting to be invested. This way, you are not relying on one account for everything. You still have a backup, but your extra cash is not just sitting at a big bank earning almost nothing. Now let's wrap it up. The Fidelity Cash Management account is not a traditional bank account. It is a brokerage account designed for spending, saving, and managing cash. It gives you many checking-style features: debit card, bill pay, check writing, mobile check deposit, routing and account number, no account fees or minimums, ATM fee reimbursement, and competitive cash options. But you need to understand the trade-offs. SPACs is not DEC insured. The FDIC sweep option may pay less. Physical cash deposits are not as simple. Zelle may be an issue. Some app connections may need manual setup. And new deposits can have holds. So the account is strong, but it is not magic. It is best for people who keep cash digitally, want better yield potential, and do not need every traditional bank feature. If you are still keeping a large emergency fund or extra savings at a big bank earning almost nothing, this is worth looking into. because your cash should not just sit there. It should stay accessible. It should stay organized. And if possible, it should work for you in the background. That is why the Fidelity Cash Management account is getting so much attention. It does not just act like another account. For the right person, it can change the way they manage cash. And once you compare it to what many big banks are paying, it becomes very hard to ignore. But this is only one option. There are also high-yield savings accounts, treasury bills, money market funds, and other cash accounts that may fit different people better. So before you move your money, compare the current rates, check the protection, understand the limitations, and choose what fits your situation. Because the goal is not just to leave your bank. The goal is to stop letting your cash sit in the wrong place. And if your money is going to sit somewhere, it might as well be somewhere that actually pays you.